Hi, I'm Jimmy. In this video, we're looking at Amazon stock. So this video is part of our Magnificent 7 analysis, where we're analyzing each of these 7 companies to see which ones look like they could offer the best opportunities today. So for Amazon, we're going to start with the basics of Amazon's business. Then we're going to look at some recent developments around their financial statements. Then we're going to try to come up with a fair value for Amazon stock using discount or free cash. So when we jump over to the Investors Grow website here, by the way, link in the description below if you want to sign up to get access to this. But over here, we can see on their yearly chart that Amazon stock is up about 43% over the past year. So at up 43%, it could be possible that this stock is currently not undervalued. Either way, let's jump in and look at their different business segments. So here we can see that their largest business segment is their traditional Amazon online store, the traditional Amazon.com you might go to. That represented about 41% of revenue in fiscal year 2023. Then their next segment is this purple segment here, represents about 25% of overall revenue. This is third-party sellers. Now, third-party sellers is huge in Amazon. Picture all of it ranges from small companies all the way up to large companies. You might have a company like Nike, has their own Amazon store page. You can buy product through that. Well, if you're a smaller business, you might use something called fulfillment by Amazon, where Amazon will store your product and ship your product for you, and you basically just have to drum up the business or make the product. So it allows a lot of different businesses to access Amazon's enormous customer database. And that's really the strength of their business. Although going forward, the strength of their business may change a bit. And that brings us nicely into their next largest segment, which is AWS, or Amazon Web Services. This represented about 16% of total revenue. AWS is a suite of cloud computing services. Think of things like storage or databases, analytics, machine learning, artificial intelligence. This has been one of the big drivers for AWS and a lot of companies recently. But they have millions of active customers each month. And this has been one of the primary drivers of growth. We're going to look at this a bit closer when we get to some of the numbers. But this is one of let's call it the future of Amazon, or the potential future of Amazon. Then we've got their advertising segment making up about 8% of revenue. So remember those companies we mentioned before that they access Amazon's large database of customers? Well, they can pay to have their product move to the top of the search, kind of like Google does. Again, we'll come back to this later, but that represents about 8% of revenue. Then subscriptions represents about 7% of total revenue. This is things like Amazon Prime. They have music. They have audible.com. They have their Kindle Unlimited packages. They generate a decent amount of revenue just from subscriptions, which makes a lot of sense. Then their smallest segment is their stores. I'm talking physical stores. They own Whole Foods. They have Amazon Fresh stores. They have Amazon Go stores. That represents about 4% of total revenue. Okay, now let's jump in and try to look at some of the numbers for Amazon and then see if we can come up with a fair value for Amazon stock. So first up, we get a chart of revenue. And I know what you're thinking. This is a beautiful chart. Clearly, this company has been gradually increasing revenue a lot over the past decade, which is quite impressive. But I think even more impressive than that is when we jump over to gross profit margins. Well, gross profit margins, just so we're on the same page, gross profit margins is a company makes a product, they sell that product. Well, what did it cost them to make the product? That's generally cost of goods sold or cost of revenue, something, depending on the company, they'll call it something like that. What is remaining is gross profit. So after what it costs to make the product, what is the gross profit? What I find to be impressive about Amazon is look at this gross profit chart. A decade ago, this was in the low 30% range. 30% gross profit margin is not too bad, but this has gradually trended higher. In fact, in recent years, we went from low 30s to high 40%, and there's no real indication that this is going to change all that much. I have a feeling this is going to continue to eke higher over the coming years. And one of the reasons for that is their Amazon Web Services business. But the weakness of this company for now is when we jump over to net income margins. So net profit margins is what percentage of revenue remains after all expenses are paid, after taxes, after costs, after sales, after everything. How much is remaining at the end of the year? Well, we can see that this number too at least early on, was trending higher. And we could see 2 years ago, they had a big pullback in their growth, in their net profit numbers. And that was because they had a big write down. It was a $12.7 billion write down of their Rivian automotive investment. So that number there, those are kind of one-offs. These are US GAAP numbers that we're seeing. So these are the accounting ones that we're seeing. Really, I'm not overly concerned about that because I would add back that $12.7 billion write-off because it's a one-time event. That won't happen again. Either way, when we look out into the future, analysts are expecting for this number to land over the next 5 or 6 years to land in the low single-digit range. I'm talking 10, 11, 12, maybe 13% net profit margins, which is quite good. Okay, now with this in mind, well, the question is, what would be the best way to value this company? I've seen many people talking about, specifically around the AWS or Amazon Web Services, that this company should get valued more based on its potential. Amazon Web Services has an enormous upside. We've seen it with Microsoft Azure, with Google Cloud. We've seen it, the effect of AI in general. But to jump and say that this company should be valued like a Microsoft or a Google, I think is a jump a bit too far. Now, the primary reason I believe that Amazon should not be valued in the same way we would value Google or Microsoft is because much of their revenue is generated in different ways. So if you think about Amazon's core business, their sales, their online store, as well as the third-party services, those are other online stores essentially. Well, that revenue, and there's a ton of that revenue is really a commodity business, kind of like a Walmart. Amazon has made their name by being one of the low-cost offers out there for most products. Well, if we were to jump over and look at Walmart's net profit margins, we can see Walmart's net profit margins are low single digits, and this company is far more mature than Amazon is. Now, I hear what you're saying. Walmart's business is they don't have enough in common with Amazon and all the other things like AWS that Amazon's doing to grow. Well, what happens when we jump back to the website and on Google's page, we jump over to their net profit margins? Well, now we can see that Google's net profit margins are in the mid-20s. In fact, if we expand this a bit and go out 20 years, well, we can see that their lowest in the past 20 years was 11%. On average, they're about in the mid-20s. And basically, what this means is that for every $100 that, let's say, Google earns, 20 or so dollars would be profit. For Amazon, we saw for every $100 that they earn, maybe 11 or 12 or $13. What happens when we jump over to Microsoft? Well, Microsoft has an even bigger moat compared to Amazon because when we jump over to Microsoft, well, we can see that theirs are in the mid-30s. And when we look at Microsoft's 20-year numbers, we can see their low is 13%. And in the past few years, they're sitting above 30%. So that's a big, big difference. Companies that have bigger profit margins tend to trade at a higher multiple, or they get a better valuation. That being said, let's jump over to our discounted free cash flow analysis for Amazon stock. Okay, now before we look at the actual fair value that's calculated for us on the website, well, here, this is a chart, and this chart is extending out 10 additional years past historical numbers. We can see that we have analyst estimates for the first 4 years. Now, many times for most companies, we could just stop there, stop at 3 or 4 years of analyst estimates, and then just take that fair value, and then we can do our analysis and see if the company does the company have faster growth? If it does, it might make more sense to extend out the years to try to smooth that growth a little bit. Because essentially what happens here is that, let's say we're going out just 3 years. Well, our perpetual growth rate, the perpetual growth rate that I'm using is 2.5%. So we assume that everything beyond our estimation period, whatever we're forecasting, everything beyond that grows at 2.5%. It's kind of illogical with a faster growing company like Amazon or many other of the Magnificent Seven stocks to just stop right there. So if you extend it out a bit, like we did here, well, we can see that essentially what happens is the computer calculates free cash flow estimates going off of the most recent analyst estimate and kind of smooths out the curve. So the number would gradually get smoother. The growth rate gradually decreases until the year after our time period here grows by 2.5%. More importantly, when we jump over to the fair value calculation, for those that don't care about how it's being done, well, going out 10 years, we get a fair value of $199 per share. This assumes that free cash flow on that chart that we saw a second ago starts at 15% growth, free cash flow growth, and it gradually declines. So it might go 15, 13, 11, and gradually goes until it gets to 2.5%, and then it stays there forever. Now, if you think that Amazon's growth will be faster than that over the next decade, then this number is a bit conservative. I personally prefer to be a bit conservative. Either way, this stock's trading at about $175, $180 per share right now, and the fair value's at about $199 per share. So right now, Amazon stock looks a bit undervalued. So the question is it worth adding Amazon's stock to our own investment portfolio? Now, me on a personal basis, I'd actually like to see this stock fall just a little bit before I add it. Generally, for me, I like a bigger margin of safety because I'm only using a required rate of return of 9% and a perpetual growth rate of 2.5%. So I'd like to see a slightly larger margin of safety. Plus, there's one other chart that I think is important to consider when we're thinking about coming up with the fair value for a stock like Amazon, and that is the number of shares outstanding. So again, on the website, when we jump over to their shares outstanding, we can see shares outstanding for this company have gradually drifted higher, and ultimately that adds dilution to the company. Most big companies, Microsoft, Google, all of those guys have been buying back shares, which takes shares off the plate and makes our stock worth a bit more. This one's kind of going in the opposite direction. Now, I really love where Amazon's at, and if I owned it right now, I would be sitting on it and holding it. But for me, on a personal basis, I'm going to keep this stock in my bullpen and hope we can get a bit more of a pullback. Then I'll consider jumping in and adding this to my portfolio. So this is a good one. This is one of those that if it gets down to about a 15, 20% margin of safety, I might jump in and buy it there. But let me know what you think in the comments below. Now, if you're curious how to research a stock, I actually did a video called 8 Steps to Analyze a Stock. I got a link right here to that video and in the description below. And if you want to get access to this website, this is investorsgrow.com. Link in that in the description below as well. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.